So good evening everyone. My name is Maurya Hanspal, and in this session we're going to continue our previous sessions on wealth management. So we were discussing quite intensively about the topics of wealth management, and this is our session 5th or 6th till I remember. And in the previous sessions, if you are interested in understanding the concept of wealth management, and if you are interested to make a career in the field of wealth management, then this subject is very important. And you can watch the previous recordings, like which were available through the YT live sessions on YouTube. So talking about the wealth management, we have talked, like we started with the discussion in the previous sessions on mutual funds. And we talked about the different types of mutual funds. What exactly is a mutual fund, and what do we mean by a mutual fund, the different categories of mutual funds. And we talked about the three most important types or the three most categories of mutual funds, on which you have further subtypes as well within that. Talking upon on the basis of the structure. On the basis of the structure, you have the open-ended, the closed-ended, and interval funds. On the basis of type or the style, you have the active or the passive. On the basis of your investment objective, you have equity, debt, and hybrid. So all these things we try to understand, and we try to understand what exactly do we mean by these types of things. Further, we also talked about the most important trend which is currently going nowadays in the market. Talking about the target maturity funds and the fixed, like the fixed maturity plans, the FMPs and the TMFs, target maturity plans, TMP basically, right? So all these we try to understand the difference between the two, and in this volatile environment, like where the stock market is volatile and even the interest rate also we do not know. In the US markets, in the abroad markets, the stand is hawkish. By hawkish, I mean that they are considered about inflation and they've started to increase the interest rate on yields. And talking about the Indian market stands dovish. That is, it is paying more heed towards growth and employment rather inflation. Right. So all these things, so we can also see even the interest rate environment is also very volatile. In that case, it is best to invest in these target maturity funds. Right. So we stopped in this slide in the previous session and what we were exactly talking about. So this graph, it basically shows your return on the x-axis and risk on the y-axis, right? The return on the x-axis and risk on the y-axis. Okay. So they're talking about for how much risk or how much return these investments are giving you. The higher the risk, the higher the y-axis, the higher return, the longer the x-axis. So in case of the arbitrage fund, we can say these funds have a lesser return and a lesser risk exposure. So like similarly for conservative funds, for equity saving funds, for multi-assets funds, for aggressive hybrid funds, for balance advantage or dynamic asset allocation funds. These funds we try to talk about. So these have been segregated on the basis of the risk and return. Now the most important thing, talking about international funds. Why is international investing important? Or should we really invest in international markets? So when we talk about international funds, it basically means talking from the perspective of India, since we are Indians. Okay, if someone is US, in that case, the international funds might be the funds of India, right? But since we are the citizens of India, the domestic funds are the domestic companies which are listed within India. But if we want to invest into companies outside India, it is also possible through international mutual funds. And why do we need to invest in international mutual funds? Because over the years, the dollar has appreciated against the rupee, or the rupee has been depreciated against the dollar or devalued against the dollar. Okay. So in that case, if you are investing in international markets, you would be earning more return as compared to investing in domestic markets. But that does not mean that you have to invest your entire portfolio in the international markets. You have to invest the majority of the chunk in domestic markets and try to diversify itself into debt, into equities on the basis of your risk appetite. But a certain chunk also into the foreign market so that you can have a foreign exposure. And what is the greatest advantage of the investing in foreign stocks is the first thing that I told you, the currency, the exchange rate exposure. Because over the past years, the dollar has appreciated against the rupee and rupee has been depreciating over the years. So that's a complete signal of when you are investing in the US stock, your money would be rising by a more amount. The second thing, in the Indian market, if you want to buy shares, I'm talking about the individual shares of the company, you have to buy fully, Like for example, like one of the costliest shares currently in the Indian stock market is of the MRF. It's around like 78,000 to 80,000 rupees. That is, to purchase a single share of MRF, you have to pay 78,000. Like you cannot purchase half of the share or one fourth or two third and all those stuff. But in the US market, agreed, the shares will be twice pricey as compared to the Indian market. But the major advantage is you can purchase in fractions, one third, two third, three fourth. So that is possible. So that again gives you a better exposure. Third, it is the excessive diversification in a positive manner, not in a negative manner. Because now you are investing into the stocks and sectors of both your domestic country as well as the international territory. So that will give you a further advantage. Okay. See, either you can invest individually into stocks but through the mutual funds as well, like for example Parag Parekh FlexiCap. And even recently India has crossed the maximum limit, that is the 7 billion limit of the total fund houses and 1 billion limit per house. India has crossed that limit of the foreign investing in case of the mutual funds, but not in case of ETFs. Foreign ETFs are still accepting the payment outside, because in that case, like you have the limit of something around like 700 million per, like the mutual funds, and the total limit is 1 billion. Okay, so the ETFs are accepting the payments, but the total mutual funds are not accepting the payment. So that, like, one difference you should know. SEBI or RBI, which is SEBI, has banned the mutual funds, not the ETFs, like because of the fund inflows, and those are just the temporary one. Okay, the limit would be uplifted once again. Again, your ADRs and GDRs are being traded. The ADRs are the American Depository Receipt. So what is the American Depository Receipt? So what basically happens if the people in America or US say they want to invest in shares outside America? So in that case, these ADRs are being traded on the stock exchange, and one ADR, it basically represents one stock. Then the GDRs, the Global Depository Receipt. So basically, if someone wants to invest in shares of the foreign countries, it can be America, it can be any other country except America as well. So these GDRs are being traded on the stock exchange and issued by the banks as well. Like you people can buy this, and that will give you like certain shares into that market. Okay. And the international funds invest 65% of the net assets in domestic equity. If an international funds invest at least 65% of the net assets in domestic equity, it would be called as the equity oriented fund. And if the whole amount is being invested international, so then it would be considered as a debt oriented fund. Okay, for the purpose of taxation. Then the real estate mutual funds are those funds like which are investing into the real estate market. So like real estate stocks. And it says that not less than basically the SEBI's regulators or the regulation require that at least 35% of the portfolio should be in real estate assets. If it's a real estate mutual fund, where 35% of the amount you have to invest in real estate. Then the securities that these funds can invest in include your mortgage-backed securities, your like real estate assets, equity shares, debentures of companies, all these things. And not less than 75% of the net assets must be invested into your physical assets. So that is one thing that you should take into consideration. Then your real estate investment trust, REIT. These are basically the trusts registered with SEBI that invest in commercial real estates, basically high income generating properties. At least 80% of the amount is being invested into high income generating properties or high commercial assets. So the benefit that you get here, the one benefit is through the capital appreciations of REIT. The other benefit that you get here is due to the dividends, because 90% have to distribute as the free distributable cash flows to the people who have been like investing into REIT. Till now, we have three biggest REITs. The largest one we have is the Embassy Parks. The second one is the Brookfield, and the third one is the Mindspace. The second is Mindspace, and the third is Brookfield. So these are the three real estates. Then similarly, you have the infrastructure investment trust. So what happens in case of a real estate investment trust? The amount is being invested into your properties, but not in the infrastructure, highways or railways, or projects or under construction properties. But in case of infrastructure investment projects, it is invested in those also. Then you have the fund of funds. So what happens in a fund of fund? A mutual fund is investing into some other mutual fund. Like for example, if I am paying my money to the HDFC AMC, then HDFC Asset Management Company would be giving my money to some other asset management company. So in this case, the two asset management companies are involved. Again, the expense ratio would also be higher because ultimately I have to pay some expenses to my HDFC AMC, and then the HDFC AMC would be paying the some amount as a part of commission to the second AMC as well. So in that case, the commission is calculated. Though the HDFC one will calculate a higher commission, like the bifurcation of the commission, basically the HDFC AMC or the direct AMC of which I'm in contact with, that will charge a higher commission, whereas the rest will be charging a lower one. So that is the basic objective of a fund of fund. Then you have your multi-asset allocation fund. So what happens in a multi-asset allocation fund? Like you are investing in at least the three asset classes, and minimum 10% you have to invest in the three asset classes: equity, debt, and gold, basically. But and nowadays, like people have started to shift to silver as well. Then the arbitrage funds. Arbitrage funds are basically they're taking the opportunity of like for example, like you have two indexes, the NSE and BSE. So if a share is being cheap at BSE and higher at NSE, then people would be buying at BSE and selling at NSE. Okay, but the profit margin here can be like very small or like in decimals only, because ultimately some trading expenses are also there, so that might eat away your profit. But that can happen if the market is not at equilibrium. In that case, we can say about that. Okay. Then you have the direct equity versus the equity fund. So this like we'll be talking about in the next session. Okay.